G'day, I'm Jonathan Bays, and these are our investment market thoughts for the week we just saw, where a federal election in Australia was called, and the week we've got ahead, where the biggest focus for us will be the Australian unemployment figures. We had some great news out on Friday night after the Australian market closed, with Chinese money supply figures coming in well ahead of market expectations. Total social financing was in March the highest reading in over 20 years in China. And the quarterly figures for total social financing up about 40% on the first quarter of 2018. So a huge surge there, and something that I think the markets will take confidence from in the early part of this week, and certainly pushed US share markets towards their September highs on Friday. I would say, however, I don't expect this rate of growth to continue. The National People's Congress outlined 2019 money supply growth in the order of nominal GDP, which is around 9 to 9.5%. So you should expect that 40% Q1 growth rate will ease back to the annual trend of 9.5%. So it actually means, if anything at all, we might see some disappointment in money supply numbers through the balance of the year. But as I say, it's good news in the very near term, and certainly has the potential, I think, to see markets up towards their September highs and maybe even slightly above that. But as I say, it doesn't change the caution that I feel for risk assets in 2019. Interestingly too, if you look at the mining shares in Australia, which are a real proxy for the Chinese economy, and indeed for investors' perception of global growth, they've actually started to underperform this last week, and even today after those Chinese numbers, they're actually the worst performing sector in the market. So let's just keep a bit of an eye on that. Employment numbers here in Australia on Thursday. Markets are looking for full-time jobs growth of about 15,000 in the month of March. I flag again, we've talked in the last couple of months about our concerns for employment looking forward in 2019. Not concerns in the sense of real risks, but just that perhaps we've been past the peak, and that we would see the unemployment rate push up into the high 5% range, which would mean the loss of about 40 or 50,000 full-time jobs. So to put that in context, as I say, 15,000 jobs growth in March. Maybe this is the month where we get a little bit of disappointment coming through, and that's something to be mindful of. And again, with share markets where they are, as I say, a point or reason for caution. Within our equity recommended portfolios last week, we initiated a buy on Boral. We think that with the stock, effectively at a 10-year valuation low, an 8-year relative valuation low to the ASX 200, and down about 40% in the last 12 months, that there's some value being offered up in the stock. We're not overly excited by the domestic construction market. Everybody knows the infrastructure and engineering side is doing well, and everybody knows the residential side is soft. But in the United States, where they earn just under half of their earnings, we do feel optimistic about a turnaround in housing starts in the US. The fall in mortgage bond yields is really starting to attract a lot of interest, and so we've seen mortgage applications spike up. We've also got rental vacancies in the United States at a 20 or 30 low as well. So I would imagine that building permits and housing starts actually start to tick up through the balance of 2019 and 2020, and that's a really good thing for Boral. It's probably a pretty good thing too, particularly for James Hardie. We've got an eye on that one as well. And also too, the potential, I suppose, on the non-residential side is that we get an uptick in infrastructure spending as we lead into the 2020 election, which would be really good for Boral's fly ash operation, which they purchased with Headwaters in May 2017. So Boral on the positive, and James Hardie potentially too. And the other good news we saw was Telstra closing at an 18-month high last Friday, and encouraged by the potential for a write-down in the value of the NBN, which would be really good news for all the resellers of the NBN, such as Telstra and Vocus and TPG, because we would see interconnect rates for the NBN drop and allow a bit more profitability emerge back in the resellers market. So Telstra's going the right way as well, and we think that that'll be above 350 in the next couple of months. Anyway, that's it. It's a short week. Thanks.